Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Oh, hello, everybody. It's clearly not Phil Tarrant speaking. It's Tim Neary here. I'm editor of a sister publication to Smart Property Investment Real Estate Business, and we'll be hosting today's Smart Property Investment Show podcast in the place of Phil, who is away. Look, we've got two guests on the show today. Very exciting show ahead of us. First of all, Director of Hunterwood Solutions and founder of Slipstream, mortgage broker, John Manciameli.
Very good.
Hello, John, and good day. Welcome to the show. And also with us today is a friend and colleague at Manciameli, director at Manciameli, Alex Whitlock. Hello,
Thanks
Alex.
for having me on, Tim. I managed to slip in when Phil's away. I sort of see the door open and wend my way in.
He normally is very protective over
Keeps
who
me
gets
out.
in. Yeah, absolutely. He's like that. Anyway, let's get into it. Now, John, we were just talking a little bit. There's two big plays at the moment in the sort of the investment landscape. Obviously, the APRA changes, and also just more recently, the Royal Commission. So I wanted to chat a little bit today about kind of the impact of those things and some of the things that you're seeing on the lending side of the property investment balance sheet.
Yeah, we live in interesting times.
We do.
Absolutely. Some of the knock-on effects. What are you seeing first up? How's that impacting investors in the short term, in the immediate term?
Yeah, great question. Look, there's no secret that interest-only loans and investment lending has become a lot harder. You know, I was looking at some interesting data that 25% of borrowers last year wouldn't qualify this year.
Yeah.
So there's a bit of hurt happening out there, and it's stifling people's property aspirations.
I think it's a number of things happening. You've got sort of regulatory changes taking place. You've got sort of a changing property market. You've got sort of more conservative sort of lending practices. I'm an investor, and one of the reasons I want to jump in and sort of get involved in the podcast, I've got I'm Phil's business partner. We've got a portfolio that's up, I think it's about 7.2 million, and it's, you know, we're at a point now where we're looking to sort of try and refinance that and to use that to leverage, but it's getting really, really, really tough. What are the constraints that you're finding when you, as a broker, when you're sort of trying to take maybe existing properties and refinance, so people are looking to leverage? What sort of constraints are you getting with the lenders?
Yeah, there's two at the moment. So there are some lenders who have an appetite for investment lending, right? So, you know, your bank may not be that particular type of lender at the moment. So it's really important that you're starting to deal with lenders who have an appetite for it. Okay, number one. Number two, unlike the past, you have to send in your bank statements showing your lifestyle. Whereas before you had to demonstrate what your expenses were and just write it down. Right now, if you've got a gym membership, if you've got Netflix, if you've got, you know, daycare, and that's showing up on your bank statements, that's going to be added to your living expenses.
Genuine serviceability, really, you know, rather than sort of, I only spend $1,000 a month, you know.
Yeah, so what we're finding is that's catching a lot of people out. And, you know, we are suggesting to clients to come back to us in 3 months' time with a bank statement that shows some of these things removed.
Yeah, okay.
So, you know, at the coalface, what we're saying is, look, you know, do you really need that gym membership?
Tighten up. Yeah, absolutely.
Which is a terrible thing to say, right?
No.
Netflix, do you really need that reoccurring monthly expense?
It's about priorities, isn't it? I mean, if you want to get into the property investment game, then you might need, as you say, to go with that serviceability side of things, to have a look at what it is that's more important to you.
But it's old-fashioned budgeting, you know, in the days before, you know, sort of online banking, you know, and in the days before, you know, so credit was so really still very easily available. People had to save, and I think it's just going back to old-fashioned values and making sure you can service your loan. But I think it's a great point, John, in terms of thinking very strategically as a borrower or a prospective borrower about a bit of discipline in terms of how you spend your money and where you spend your money.
Yeah, and you know, there's some talk in the industry at the moment to say, has it gone too far? Because, you know, first homeowners are struggling to get in as a rent investor. And, you know, it's obvious that when you become a rent investor, you're going to pull back some of those things. So, you know, you're not going to keep eating out every day or, you know, go on an overseas holiday. So there is talk in the industry saying, look, it's gone too far. So there was some data that came out yesterday that's saying that interest-only loans, for example, it's down to 16%. So new interest-only loans is down to 16%. Now, Q2 2015, it was 54% of all home loans. And that was obviously excessively too much.
Yeah.
But now it's gone way too far. It's gone down to 16%. And it's still plummeting. So are we making it too hard?
Yeah.
You know, there is got to be a degree of common sense there and sensibility. So it's obviously important to budget, But
and you talk about common sense and budgeting, and a little earlier you mentioned sort of a 3-month cycle. I guess come back in 3 months. You were saying to some of your clients, it goes through cycles, does it? That something will happen, the banks will tighten up, and then the market will shift again, and then it changes again.
Yeah. So earlier this year, I was rejoicing with the fact that 95% home loans are back for investors, which is great.
Yeah,
they hadn't been around for a while, and it was lovely to see that. So there are cycles. Whether you qualify with that lender to do a 95% LVR or loan to value ratio, don't know.
So what I like to, being somebody who's obviously keen to expand my own portfolio. So what would be on that basis for a lender that's prepared to go to 95%? What are the things they're going to look for on your outgoings, and what are the alarm bells for lenders around that 95%?
Yeah, look, those type of lenders aren't going to lend you as much.
Yeah.
All right.
Okay.
So, if you're strong and you've only got a small deposit, then you might qualify it. So, there are some other lenders who might go to 90% and lend you that extra 100,000. That'll get you into, a house instead of a townhouse.
It's a really good point. It's a really good point that you bring up, Alex, because we're talking to property investors across the spectrum. So you would have almost two groups, wouldn't you? You have those that are getting into it to start off with now, and then those that are already in the business that are looking to expand, which is what you were talking about there. So when we talk about the loans and the lenders, it's not just one category. There's various variables to that. And each one needs to be positioned to which sector of the market it applies to.
Yeah. So there are lenders who may have an appetite for you to develop. You want to put a block of 20 units up, and there are others who have only got an appetite for, 2 duplexes.
Yeah.
Or you might be starting out and just buying your first home, but it's a rental. So there's different lenders at different categories. So it makes our job very interesting, sadly.
Yeah. So talking about that, let's maybe just use you, Alex, as an example. When you started out, when you were looking to borrow for your first investment property, how did your situation, and now you're looking to expand your portfolio, how's your situation changed from then to what it looks like now, and what does that impact, and how does that impact on the professional team that you put together, in particular mortgage brokers?
I'll give you a couple of stories. So first, my first property was an off-the-plan purchase. I'm not Australian. I was living in Hong Kong. I've always loved Australia, and I always loved Australian property. And I knew quite a few Australians then. It's just in the blood here, Yeah. So I bought an off-the-plan, or set out to buy an off-the-plan apartment in Melbourne South Bank. It was a 2-bedder. The price was $217,000 at the time. It's built by Central Equity. So I'd saved a little bit of money in Hong Kong. I'd probably scraped together about, I'd got a sort of around about a 10% deposit, about 20,000 Aussie at the time. So I put that down as a deposit, and I then had another year and a half or thereabouts, sort of 18 months to go and save, the rest of the 20, because at those days it was a 20%, and even that was like the maximum LVR. So I saved. I did without. Me and my wife, we got a young family. We did without. We saved. We budgeted and worried, and we got this. We got this money together, and then and then we purchased, and and so we lived in Hong Kong, and we didn't see the property, and that sort of carried on. And I ended up buying because I developed those kind of muscles and that kind of discipline to save, and I got a goal, and so we saved up and bought. Then I bought a 1-bedder from the same developer, $167,000. Would you believe it? In the South Bank. And then I saved up, and I bought another 2-bedder, and then by this stage, the 2 that I'd bought had gone up, so I refinanced. So that was my first, entry into buying property.
To your point that you mentioned earlier, and your point too, also, John, where you were saying, what are you prepared to give up in order to get the goal that you want? You were talking about developing those muscles and getting that discipline around that savings.
Yeah. So and saving's always been hard. It hasn't changed, Yeah. I think it's easy to be sort of fatalistic and look at the Australian market now and go, I'm never going to get in. And the thing is, things have changed. And yes, the Australian market is proportionately very expensive compared to, 1998 when I bought. But there is, and despite our sort of current conversation around tightness of lending, there are still lenders out there. But I think if you dovetail that with discipline, with
and
focus,
research.
and look, with what you buy is another thing aside. I mean, I just bought. I used to sell advertising to Central Equity, and I used to have to go in there to sell them adverts every time in a magazine I ran, and I'd have to walk past their model in the middle of the shop, and they used to write an article about negative gearing, and the sort of stamp duty concessions with buying in Melbourne at that time, and all the sort of the various things, and I got sort of brainwashed through reading their articles, and eventually I went, oh, okay, how much is this one here? So I didn't really research. It was a relation. Awesome. Yeah, But I think you're absolutely right. I think the other, aside from funding and building up your resources to buy is then buying the right kind of property.
Yeah. Look, the banks love seeing disciplined, and if you've got a 12-month bank statement showing that you've regularly put $500 away or whatever it is, they love that at the moment. And then, I love Australia. This country offers so much opportunity.
Yeah.
And for all of you listeners out there, you've really got to believe that you haven't missed the boat. You really haven't missed the boat. If anything, I am more excited now than I have ever been in the last 15 years in this business, because there's 3 capital city markets, if you want to focus on those, that are really exciting right now. And there's a few regionals as well. So, and it doesn't have to be expensive. You really can buy stuff that's nowhere near the capital city prices that we're seeing. So, get your order, your stuff in order, and show the discipline. Even show you've been making your rent payments on time, and then show that $1,000 a month or whatever it is, and the banks will love you for it.
Get your cash. I agree with you. And people ask me, if there's ever a sort of a good or a bad time to buy property, and I think there's always a good time to buy property, but you just have to maybe change the focus on what you're looking for. And I think in a market now, you could argue it's very much in most markets it's a buyer's market. But what does that mean? It means people are taking their time to buy. It means properties aren't selling. It means that prices are perceived to be maybe sort of heading downwards rather than heading upwards. And for me as a buyer, that means you get real opportunities, because you'll get a property now that's maybe hasn't been renovated the way it should be, or hasn't been decorated, or it's just dirty, or the garden's a mess. And guess what? What happens then is the value or the price or the perceived value of that property starts to fall. So as a disciplined buyer, whether you're buying yourself, whether you use an agent, which I've always used a buyer's agent since I've been in Australia.
Fantastic.
But, yeah, because I can hypothesize, but I still trust a buyer's agent. I can look at what they put in front of me with Phil, my business partner, and then we'll make our mind up. But I think if you don't use a buyer's agent, I think you can still spot gems if you want to do it yourself, even in a flat or a buyer's market, because people aren't buying. So there's always opportunity.
We're at Slipstream, we're very big fans of the property clock, and it suggests that there is a time to be buying and a time to be selling, and if you want to sell. But there are markets at the moment that are rising, so it doesn't take a lot to look at those particular markets that are rising.
When you get people that come in, John, to your office and they're looking to get into the business, we're talking about first time investors. And they're either in the market or they're not. I mean, they either qualify for the loan or they don't. And for those that do, and you gave some good advice earlier around the savings and getting the paperwork in order. But those that are close, that aren't quite there, what advice would you give to those people?
Hang tight. There are different ways of doing it. So if mum and dad have got some equity, the rise of family equity, that's a really, really good way to start. That's where mum and dad provides the equity, and you can borrow 100%. And then all you do is whatever savings you got, you put in your offset account. Okay, so that's one thing. The other thing is start looking at your credit card limits. That's an obvious one.
Yeah.
Banks don't care.
Get rid of them. I got rid of mine. I use a master debit card. I can't stand the credit cards. I hate
so
them.
the banks don't care how much you owe. It's actually what the limit is. So sometimes we've had...
That catches people out, doesn't it?
Yeah. We've had clients come to us saying, I didn't service. And all they did was look at their credit card limit, and they had
you got a
$40,000 limit, and we went, just get it down to 5.
And guess what? The banks push them up. They put your limits up, and then the next thing, and it's
cheeky. It's really cheeky. It is a good point, because you might only owe 5 on it, but you got the $40,000 limit, and that's what they take. Yeah.
And then maybe start looking at properties that have got a high yield. So does it have to be a capital city play? It might be a little bit more of a regional play. So without giving advice, the Sunshine Coast has a 6 to 7% yield. That might be something to look at. So you're renting in Bondi, living the lifestyle, and investing in another location. So that's not advice, but that might be something.
I bought a place just over a year ago in Brighton, in just outside of Hobart, and it, part emotional, part kind of. I went down to Tassie and thought, wow, this place is absolutely unbelievable. Then I thought, I'll have a bit of a look at the market. I saw that there was a tightening property market, and that there was sort of just the start of a growth in terms of sort of house prices, and it's a really tight rental market. And that place has gone phenomenally well. And I get, and I've had really good capital growth, and I've got really, really, really solid rental on that positively geared property. So they're out there.
Oh, there's lots of places at the moment. So
I want to drill down on that a little bit more, Alex, because we hear this in property investment a lot, is that to separate the emotion from the fundamentals and to go and think about it as a business. How do you do that?
Oh, look, I think, you know what? Property is not stocks and shares. I mean, stocks and shares are completely neutral. I think property, it doesn't matter whether it's an investment property. There's just something that you love about it if you're an investor.
So you've got to feel something for it.
You've got to feel something for it, and that's a great thing. But you're not buying something that you're looking to live in yourself. You've got that vision of appreciation, of building something for the future for yourself or for, maybe for your kids. But you still kind of... there's still that sort of warmth around property. So, like I say, I went down with my wife just down to Tassie and to Hobart and travelled around and thought, God, this place is great. And then I thought, I'll have a quick look at the numbers. So that's where the analytical side came in.
The art and the science.
And I had a chat with my buyer's agent, who I know well. And I said, oh, look, I've been down Tassie and I thought, Hobart. And he went, yeah, look, you know what? I'm just starting to look at that market. So I went, I'm in, get me something. Get me something. And it's done really well. I've just bought. I haven't bought in the Sunshine Coast. I've just bought in Deception Bay just recently. Bought a couple of places there.
Congrats.
Bought side by side 2 blocks next to each other with a view to, again, sort of something you sort of touched on. I've bought that because it's got quite good yield at the moment. The 2 blocks together was $600,000, but as it's combined. But there's a scope for that further down the track. If Deception Bay goes the way that maybe people think it's going to go, that I can stick some units on there. So
the macro fundamentals there are outstanding. Yeah. So when I meet with clients, there are 4 key growth drivers that I go through with clients. So if you don't mind, I'll go through them.
Yeah, please do.
The first one, and this is traditionally what's always caused price growth. So supply and demand, number 1. You see more demand than supply. Okay. Number 2, economics. Okay. And employment. So what we're looking for is a deep economy and a broad economy. Okay. So with jobs, there's always going to be people demanding property. Demographics. So where are those areas that are changing from, say, a blue collar to a white collar? I'm generalising there, but you know what I'm saying.
Yeah.
The Holy Grail, the last one, number 4, is infrastructure. Where's that new freeway? Where's that new hospital? Okay, so when you get that new hospital, the demographics around the area start to change and things like that. So there are the 4 key growth drivers that my slipstream brokers and we go through with clients and say, and as a result of that, here are the areas that have got some sound fundamentals, and it's stood the test of time.
Yeah.
Okay, and then from there we go into the micro fundamentals, but.
I like what you're talking about there in terms of the common sense and the fundamentals, but I also like what you were saying also around bringing that sort of that art and the science together, that there has to be some feeling for it, because although it's not going to be your home, is it?
It's going to be somebody else's.
It's going to be somebody's home.
But to John's, to John's point, and the great thing is that there's not one area that ticks those boxes. Anywhere in Australia, in any state, at any time, there are a number of these places. So whether you use a buyer's agent or somebody like John to help you identify that, or whether you want to go out yourself and go and look, these places, you read the newspaper, look online, you'll find where there is infrastructure planned, where infrastructure has recently been put in, where there is jobs growth, where is the migration, so you've got the tools to help you get there. And then, whether you want to buy yourself or use a buyer's agent, you've also then got, a mortgage broker who will help you assess the financial feasibility of the purchase, and start to look at, whether you can get it sort of neutrally geared or even maybe positively geared, and what kind of LVR you're going to need to do that, and how much savings you got and what you can get together and so forth.
That's a good point, Alex. And I'd like to add to that is try and find a mortgage broker or a finance professional that specialises in the investment property space. We help a client understand how to buy something for $20 a week. Not joking.
Yeah.
So we go through asset holding structures. So is a trust relevant for you? Or was tenants in common relevant for you? Or the recent depreciation.
Let's get into trust for a second. Not everyone's familiar with trust structures. They're complex. Can you just give us a bit of an idea of, so when would you recommend to a borrower that they buy it in their own name, and what sort of scenarios would you suggest starting to look at a trust structure?
Trusts are usually set up for 2 simple reasons.
Yeah.
1, protection against litigation. Full stop. Okay. Just pure asset protection. And number 2, to a lesser extent, family estate planning.
Yeah.
Okay. So if you're someone in quite a litigious environment, it's a really good idea to put your assets in a trust. And there's 2 types of trusts. There's a discretionary trust, commonly known as a family trust.
Yeah.
And there's a unit trust. Now there is a third one called a hybrid, but don't go down that path. Banks don't like them. They will not lend. Now, if you're the sort of person that wants negative gearing, the first one that I mentioned, the discretionary trust, you will never be allowed to negatively gear. A trust can't pass losses. Okay. However, if you set up a unit trust, without going into too much complication, you can negatively gear through that manner. All right. So that unit trust structure is a great way to negatively gear. and provide some asset protection and family estate planning.
So kind of
now,
like
for most people, they don't need it.
So if you run a business and you want to start building up a personal investment portfolio and you want to protect and segregate that from your business, should you end up getting sued or anything like that, that's one scenario. And then maybe if I'm looking for a bit of continuity and sort of something I can hold within the family and have it, delivering.
Perfect.
Yeah.
So
okay.
the beneficiaries of the trust could be the kids.
Yeah.
And that lives, I think, don't quote me on this, I think it's 99 years. Is that right, Alex?
I don't know.
Yeah, it lives on for longer than we will anyway.
Yeah.
So it's a really good way to protect your assets.
Yeah.
But very complex. Is it suitable for everyone? Absolutely not. Most people, even if they are self-employed, probably don't need to go down that path. But, asset holding structures are really important. It's probably the thing that I start talking about before even borrowing.
Okay.
You're right, because it has tax implications as well. And, litigation as well. So if you're an excavator in a building site and, you're working on areas with dynamite or whatever, and something goes wrong, that's a really important thing. You go off and talk to your advisors, accountants, financial planners. So, we will go down that path.
So I've got a quick question for you, John, and you will have many clients across many different sort of asset classes. I know that, you've got people who are buying in Sydney and then people who are buying elsewhere, sort of ranging from millions and millions to sort of hundreds of thousands of dollars. What are you seeing in terms of people you've worked with in the past, in terms of their holdings? How are they viewing those holdings? Are they looking to refinance loans to get a better rate at the moment? What sort of things are your investors, so how are they treating their portfolios and their financing at the moment? Yeah,
we do an annual home loan health check, and it varies. It comes down to where they are in life.
Yeah.
So some of them may start off as a rent investor and they start having kids and they'll buy that next in property, but it will be a new one because they don't have the headspace with young kids to get into, property development or renovating an old home. It really comes down to the individual and where they are in their stage in life. That's what I've noticed. And then there are life events that happen, divorces, starting a new business and things like that. So as Slipstream brokers, we're very much focused on trying to get that client into their next property.
Okay.
Because I think sometimes you need someone to kindly push you along a little bit and say, come on, you've got some equity, you're paying a bit of tax, come on, let's go. You've got the borrowing capacity. Are you ready mentally for it?
Yeah. So that's
the big thing for most people.
If you've got a portfolio or a property, never mind, let's say you have some, sort of assets, is there still good scope to leverage off that to release equity? Because I know it's a tougher funding environment.
Tough.
Yeah.
It's really tough.
Yeah.
I'm not going to sugarcoat this.
Yeah. No, I know because I've gone through it myself very recently.
Yeah, and I don't know. Look, the Royal Commission hasn't finished yet. We don't know what environment we're going to end up with, but I think this is going to be the new norm.
Yeah. Okay. So so you're saying that if you've got equity, you can do it, but it's tough. You've got to have all your ducks in a row, and then in some other circumstances, maybe it's worth just sitting it out, sweating it out for another few months and.
12 months.
12 months, okay.
Yep. You might need to change the type of property you buy. You might need to buy something that's a bit more of a yield play rather than a capital city sort of low yield capital growth type play. I'm simplifying that a little bit. But
yeah.
John, you talk about coming back to it if you're not quite there, if you're close but you're not quite there. Is there any time when you would just say to somebody, no, you're turning it down, it's just this is just not a start, it's never going to get across the line?
Unfortunately, I do it daily.
Yeah. And what do those look like?
Yeah, look, we've got people who got very high lifestyle and they need to pull it back and present it to the bank. And a classic example, I couldn't believe this. Wonderful client earning incredible money, $500,000 in the first year, like a lot of money, and then $400,000 in the previous year.
Wow.
And he had $300,000 in savings, right? A UK resident coming out here buying his first property. So we suggested to him, go off and buy 2 investment properties. 4 months it took to get through. Why? Because the bank statements, what we sent through, had these incredibly big withdrawals. So the bank, each one of them said, why did you take out $6,000 here? Why did you take out $4,000 there? So there's this new paradigm where you really need to not just present your income and your expenses like pay slips, but you really need to make sure that you can demonstrate that your lifestyle is one that can afford the lending.
Can I just say, I'm 51 years old. I've been around through various sort of cycles, and it is incredible. There are so many draws on your money these days. It's
so hard.
It's so hard, and I think when you're trying to save, when you're trying to build up a profile that's going to appeal to a bank, having discipline and really taking stock of the situation and understanding how easy it is to let money slip through your hands. You go on your computer to look at what the weather is, and you're followed around by programmatic advertising that will have, in my case, fishing tackle.
Yeah.
I go,
oh God bless you.
The next thing I'm down the rabbit hole. I'm buying jigs to go jigging at 12 mile. But
if you came to me, I would have got you approved straight away.
There you go. You see, but John, it's just hard for people to it's easy for money to slip through your fingers.
Yeah.
You know, and banks, and to your point, banks now are scrutinising those habits, and I think it's a really good point for everyone just to think about where money slips through your fingers. And you know, look, $6,000 cash withdrawals is, you know, that's
it's
big.
It's worth a question, that isn't it?
Yeah, but
worth
you know,
question
the
that.
thing is, in the past, the banks would have said, look, that's your money, it's your prerogative. If you want to, you know, literally drink it and up the wall, then that's up to you.
Yeah.
Nowadays, the banks are going, no, what's this all about?
Yeah.
What's this all about? Have you got gambling problems? Are you know, all these sorts of things. And we never saw that before, but anyway, the good news is he got through.
And
So.
then,
Good.
Yeah, and there might be another sort of leaf to this as well. And this positive credit reporting coming in, is that changing
I'm
the
looking
game?
forward to that.
Yeah.
How far off that?
How far off is that? I'm not exactly sure.
It's actually started.
Yeah.
Okay.
So the big four banks now it's mandatory. They have to, the deposit taking institutions need to send this information. So it's going to help us. It really is, because it's going to show that in the past you've been able to pay off debt.
Yeah.
At the moment, it's a very negative environment. So, you know, you may have missed a payment, a utility bill when you moved, but you may have had.
Here's all the good things you've done.
Yeah, here's all
So,
the good things.
so that's an interesting observation, isn't it? It's not going to be a negative thing. It's actually going to help people it's going to improve the credit landscape a little bit.
Yeah. So for the vast majority, it's going to be a wonderful thing, right? Because most people are pretty good. Where it may be an issue, and it's still okay, is say you present with a few issues in the past. Now, you may have been declined, but the banks now will have the discretion to say, you know what, you've had a terrible track record. We'll give you the money, but it's going to be 15% interest.
Okay.
Right? So it's going to be interesting to see how the banks look at this.
That's one of those really weird situations where you go, oh, you're not really very good at borrowing money, so I'll tell you what, I'll make it more expensive for you.
Yeah,
That'll
make
help
it
you
heavier
out.
for you.
Let me just I'll tell you a story. So when I was in England, I used to work at a retail store called Primark, and I was a manager, and I'd always be running with a few quid in my pocket, you know, being a sort of a struggler, a battler. Anyway, there was one time where I'd asked my bank to give me an overdraft of £150 so I could pay some bills. And I spoke and this is in the old days where you phone at the branch and some punter says, oh, yes, okay, Alex, no problem. So I paid the bills. Anyway, the next thing, the bills bounced. And in these days, before internet banking, so I got 3 letters, bounced this payment 3 times, got billed 3 times £20 for the letter, and got billed for the overdraft. And then I still owed the bill. And I phoned the bank and I went, why?
You haven't helped me.
But I said, what's gone wrong here? Somebody said I could get this overdraft. They went, no, we declined it. The bank manager declined it. I went, why? He went, well, because we didn't think you could afford it. I went, hang on a second. Now, I still haven't paid the bill, and right. you've got you know £90 of charges you put on my account. Anyway, let me tell you, I argued with them and I threatened them, and I said, I'll go and stand outside your bank and shout forevermore. And they got rid of those charges, and they gave me the money to pay the bill. Anyway,
yeah.
It's a great story, isn't it?
Yeah. There's plenty of stories like that.
I know.
You know, when we look at these reports, we actually have to have, you know, stories and explain why. You know, you may have gone through a divorce and the other party, just each party didn't realise that they had to make a payment. There's a whole bunch of these amazing stories like yours, Alex. So
watch the banks.
Yeah.
But they, you know, look, they're there to help, but you just got to keep an eye. You can also, you know, I think even in these tough times, and again, the reason for using a broker is a broker will know which lenders to go to. The brokers also have, you know, you've got to understand they've got relationships on a daily basis with banks and with lenders. And so whereas you have to meet the criteria, they're in a position to really, you know, there is a trust with the broker that helps, you know, sort of facilitate deals for borrowers. So it's, you know.
Yeah, and, you know, I'd like to extend on that by saying that there's a new era of brokers. Right, so about 20 years ago, brokers came on the scene into the banking sector. But nowadays, these brokers or finance professionals have evolved to specialise in investment property space as well.
Yeah.
So, you know, it's good to see a broker, but it's even better if you see a broker who specialises in that space, because the number of lenders who will let a broker know we've opened up our appetite, we've reduced the interest rate.
Yeah.
You know, we'll help your clients with self-managed super fund lending, but they won't advertise it. Why? Because when they have done that in the past, there's this avalanche of applications that go in and it all falls apart and no one's happy. So they've really started to get very selective with the type of broker they deal with. Now, if you also find a broker that loves it, like me, passionate about it, then they can really extend it out by saying, go to your accountant and talk about trusts or tenants in common. Now, this is what's happening around Australia. At your price point at $500,000, let's go and have a look at this market and here are the pros and cons. Okay? I want to see you buy a old property and renovate it. All right, and go and talk to these people who will help you do that. I've personally vetted them. Or right now, I think you are in a position where you need to buy something off the plan. You got $100,000 in deposit. You've really got enough there. All right, so at this stage in your life, so a broker who understands you, it's almost like a coach. It brings all the facets together. That's the new era, guys.
I like the way that you put that in. And
everyone's so time poor.
And to your point, Alex, I mean, they are there to help, and they do help. The lenders do help. It's just there's a way to do it, and you've got to know how to do it. And if you work with a coach to get you to do it, then that's even better.
I think what John said is that in a conservative marketplace, lending marketplace like now, where you have got lenders that are there to lend, but you've got to understand that often the lenders that come back in are not necessarily, we're not talking about necessarily lenders with billions of dollars to lend. So they don't want to have a tsunami of borrowers who are often not going to be quality borrowers. So, and brokers will get the word immediately, and it can be quite a short gap. A lender may be in the marketplace for 3 weeks because they have that capacity to lend at that particular time at a particular rate. And so a good broker that deals with investors will know when a lender comes in the marketplace, there'll be maybe a narrow gap. So just when I went for the Deception Bay properties initially, ANZ was in the marketplace at that particular, or had just come off, and I went down a process with ANZ, and they declined me. Okay.
Yep.
But my broker during that process went, Pepper Home Loans has come in, and so
straight away. Yeah.
And although I got declined, and it delayed things. But I had to delay the settlement by a couple of weeks.
You know how normal that is now?
Oh,
it's amazing. It's pretty normal. We tell clients pretty much up front, look, we're going to probably try a couple before we get there.
And I'll tell you, John, I mean, I've got quite a lot of property. I'm not somebody who, I run things quite close to the wire because, I've got a lot of property, and to get that deal through, because if I'd have just done that on my own, I would have failed, but because my broker knew that Pepper had come into the marketplace at that time, deal through, deal done.
And your broker would have known as well.
He knew, yeah.
Also the security that you're offering. So Deception Bay, sometimes we will go to the lender and go, have you got an appetite for postcode 1, 2, 3, 4?
Right. Yeah.
And then ANZ may have been the reason for its decline. It's like, oh man, we just don't like that area.
Yes,
and then
very
Pepper's
true.
like, yeah, it's fine. So
I can remember when I probably would have been about.
So South Bank is another one.
I was going to say when years ago, probably the early 2000s, just at that point where the market really came off that peak, and I can remember banks wouldn't lend on one bedders in the South Bank. They went, no, not doing it. There's other things they would lend on, and again, having a broker that understands what all the lenders' appetite is for lending, it's not just the same across all lenders. And so some lenders won't buy one bedders. Others won't buy, won't fund studios. Others will go, yeah, no problem. As long as you can show me X, Y, and Z.
And it's just about knowing which ones will and which ones won't. And that's why working with a mortgage broker makes a lot of sense.
Get a broker, people.
Yeah. I think it's now up to 60%, guys, that most loans are originated through mortgage brokers. It makes sense. It saves you time. It saves you money. You're going to get quality advice that represents you, not the bank. And then if you find a broker that loves that investment property space, they're going to start talking to you about areas that you might want to consider at your price point. I had a first homeowner the other day, and I said, there's nothing wrong with renting. Stay on the northern beaches. You don't have to move to Timbuktu. Just stay there and rent. You love surfing, so that's okay. What we'll do is with your $450,000 price point, we'll build some duplexes up in Queensland, in the Sunshine Coast.
Yep.
And that'll allow him to be positively geared, and he's going to end up living in Milan to do the 6-month photography course. So I thought, mate, I'm going to come and see you.
Win-win. John, Alex, it's been a real pleasure this morning. Thanks very much for both of your times coming in and having a chat. All things mortgage broking and lending and investments and growing. It's been terrific. Thank you very much.
Thanks, Tim.
Thanks, Tim.
Remember to follow us on all the social media stuff, Twitter, Facebook, LinkedIn. If you've enjoyed today's show, please leave us a 5-star review on iTunes. It is the very best way for new listeners to find us and for them to get the great content that we are putting out here. As always, smartpropertyinvestment.com.au is where you'll find us. There are plenty of stories there on the business of property investment across the whole of Australia. Thanks again for tuning in. We'll see you next week. Goodbye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.